things have got better. $14 billion worth of IPOs this year. I would say it's alive, but it's not exactly kicking. How is it in the PE world? Is it alive? Is it infused, but not kicking?
Great to see you both. The PE world is more active than it might seem. I think we got used to the exuberance of deal activity in 21 and 20. And we've hit a new elevated normal. So as you mentioned, deal activity has been up 25% year on year. That's overall M&A activity. I think a lower percentage than we would have expected has been financial sponsor activity. So it's been 20% of overall M&A activity. But there's no reason not to believe that the activity will pick up going forward.
Well, the activity might be picking up, but that's buying. What they're not doing, Anthony, is that they're certainly not selling. The Bloomberg team had this really great story. It was that one big asset manager. Basically, someone was wearing its shirt that said DPI is the new IRR, which is a nerdy way of saying IRR returns don't matter as much. What matters now is returning your money to shareholders. When does that happen? When does the dam finally break and we see a rush of exits to get that money back to investors? So
60% of the M&A activity's been buying as opposed to selling. But the size of the portfolios for the sponsors they're bigger than they've ever been. We would expect this activity to pick up over 25 to 27. So the next 3 years should be a makeup. An incremental makeup for what we haven't seen over the last 3 years. So we would expect activity to be much more elevated on the sell side.
You talk about this sort of new normal, and this is something we're hearing on the tariff landscape, on deal-making landscape, on the IPO. But if you look at the sponsors, I mean, again, what level of pressure is on them to exit? It's been the lowest quarterly exit in 3 years. Do you think that picks up in the second half? Do you think the election stymies that? How would you describe the pressure on the sponsors right now?
So the pressure's high.
Sweating?
It's heating up. There's no doubt. So that's one of the fundamental reasons why we expect activity to have to happen.
Right.
I think that this year we're expecting measured activity, but again, it has been ticking up, and so I'd expect we get through the elections, move into the new year, and so I would expect Q4 to be much more active once we pass the elections.
And last time you were on, you talked about this gap, right? The gap between the buyers and the sellers. And that's part of the reason we haven't really seen more selling going into this market. So when it does pick up in Q4 over the next 3 years, does that mean people are going to start and be willing to take a discount in order to get that cash back? I
think the discount you might see will be around multiples, but earnings have been strong. So operating performance has been strong given the economic environment. So I'd expect sellers to be able to sell for more reasonable values going forward. On the buy side, of course, we've seen the majority of the activity has been take privates and carve-outs. So sponsors have gotten excited about that in the meantime. On the take-private activity, I think we've seen 16 take-privates of a size of $1 billion or more in value, which is up significantly. I mean, year on year, you typically see 5 or so.
And the buyers of those assets, I mean, again, we've got a pretty good story this morning, overnight, about the PIF perhaps looking a little bit more internally in Saudi. We'll come back to that in a moment, but I want to understand the power of the sovereign wealth funds, because they have been a destination of show us your assets, here you go, and they have been a very natural buyer. I just wonder, has their bargaining power increased significantly since we sat down with you in the autumn of last year?
I haven't seen a whole lot of change. I think the Middle East is it really is an evolving story. It's very exciting for us in the private equity business, largely because you've seen a big change in Abu Dhabi and Saudi, as you mentioned. We spent a lot of time in Qatar, for example, where everyone's forward-leaning, want to deploy capital, and the strategies are evolving.
Now, you mentioned that take privates have really taken off. Sorry for the repeat of taking, but it just points to this idea that public markets are shrinking. There's something like half the number of public companies that there once were in 1995. Only two private equity-backed firms have IPO'd for more than $100 million this year, and the only ones that are going public are the big tech names. It's remarkable to see when markets are at an all-time high that we're still not exiting via IPOs. Has something structurally shifted, Anthony?
I think the IPO market's looking for growth and profitability, and that's a big change from the last few years. We're going through a phase where the private equity buyers are able to take businesses off of the public market, which are unloved. So I think we'll see more take private activity. And deal sizes, by the way, just given the amount of dry powder that the sponsors have, deal sizes have increased, as we all expected last year. So I think we're looking at 19, year to date, 19 $10 billion plus deals, not just private equity, but overall, including the corporates, versus 10 last year. So that's a marked difference.
We spend a lot of our time talking about tech. Every day we start with a price check, not every day, but nearly every day, a price check with NVIDIA, and there's this morbid fascination as to the evangelization of NVIDIA. But then I look at the revolution that we're in. Elon Musk has just raised $6 billion. The challenge is to enter that space in ChatGPT. Give us a sense of what is going on in this AI tech frenzy. Make that come alive from the deal flow side. What's being put in front of you? What are you propositioning with?
Well, deal activity has been centered around tech. So if we think about the sectors that the sponsors have been active in, it's been tech, it's been services. Now that's tech-related services, some industrial services and financial services. But it's but some of the other sectors, such as healthcare, consumer, have been a bit slower. Because of the economic outlook. So I'd say tech would be a major focus for the sponsors going forward. That hasn't changed, but we've seen that in the deal activity so far.
Something like healthcare, though, there is that regulatory risk in there. I won't get into the details, but there's some concerns around Cerberus and what they did with some of the healthcare sector and hospital workers. And did they have something that violated some sort of antitrust, bad for consumers? With sectors like healthcare, especially as we enter into an election year, how much are asset managers looking at regulatory risk? And does that explain some of the icing over of deal flow?
It could be. Every time we've got an election year, it's deal activity is a bit more mooted. I'd say on healthcare, we're still seeing tech-related healthcare as very active, and again, people-heavy businesses will draw a bit more concern heading into the election, given regulatory dynamics.
I was just looking at something that Schwartzman said. I've never seen anything like this, and he's talking about the land rush, the data center. So it's going beyond. Danny's talking a little bit about health. You're talking about tech in itself. The slightly more mundane picks and shovels, the mortar of AI. Is that business really opening up? Are deals really getting done in a broader context?
We're not seeing it as much in private equity other than software related. And data centers, for example, on the infrastructure side of the business. Infrastructure funds are seeing data centers as a huge opportunity going forward.
Again, it comes back to this idea that all the deal flow is around tech. And there's so much about tech, but at the same time you have rates going higher, which just naturally means we're not going higher, not going lower, which naturally means that the discount model you're using is more challenging for these tech names. If we are in a world where it is higher for longer, maybe even hikes, as Kashkari has been talking about, do some of these private equity firms need to rethink their models, need to rethink the attractiveness of the assets they've been buying up?
I think that it's an incredible buying opportunity. Some of the traditional businesses aren't going away, and so what we found is that certain private equity sponsors have decided to focus more on either tech, healthcare, services, the asset lighter end of the business, and then you've got other sponsors who are entirely focused on traditional industries and thriving, by the way.